So 7, we are doing property, plant and equipment, and that is as per IAS 16. We are told that merchant purchased an item of plant and equipment, 12 million, on 1st May 2012, and they use a straight line depreciation over what? 10 years with zero residual value. At 30th April 2013, that is 1 year after what? The acquisition. So this is what we will do. Cost of the assets at first what? May 2012 is 10 million. Is it 10? 12 million. Then we're going to less the depreciation, which is going to be 12 million over 10. 1.2. Did you say 1.2? Yeah, 1.2. Into carrying value at 30th April 2013, 10.8. Listen carefully. Then on that date, it was revalued. So revalued amount on that date, 30th April 2013, as how much? 13 million. So the balancing figure goes to revaluation surplus of how much? 2.2. Then after that, the asset will be depreciated. So depreciation for the year ended 30th April 2014, and that will be 13 million. After how many years? 9 years. It's 1.4. We take it out. So carrying amount or carrying value 30th April 2014. What do I have? 11.6. At that same date, we are told that it has been revalued. So revalued amount on that same date to where? 7. So meaning we are now going to get a revaluation loss of how much? 4.6. But remember, that asset in the previous year, you had recognized what? A revaluation gain of 2.2, and now you are getting a total revaluation loss of 4.2. So it has to be splitted. So you're going to be removing that. So you go to debit the revaluation surplus. Surplus, revaluation surplus, let me do this one. Revaluation surplus with what? The 2.2, and then credit property, plant and equipment with what? The whole 4.6, and then the balancing figure will go where? Income statement as what? 2.4. Is it 2.4? Yes. 2.4. So this is how you account for it. So that is the presentation. Let me see how nice are presented by. So that's it. So that's note 6. That's what we do for note 6. Systematically like that. Indeed, the only thing we are going to be accounting for here is this loss. When we are preparing the group profit or loss account. Note 7. Note 7 is where I said it's on share-based payments, IFRS 2. And in this question, it's about share options. So, let's see. You remember that I mentioned that under share-based payments, what did we say was share-based payments? Yes, what did we say was it? Who can give us an idea about it? Yeah, golden handcuff. That we put on what? Management. So share-based payment is a motivation or motivation scheme that we give to management to tie them to work for the company for a given period of years, okay? After which they have a right to either be given an amount of money, that is share appreciation right, or an option to buy a share, and that is what? Share option. So there are two things. Share appreciation right will give them money, but share options will give them a right to buy some shares in the company. The way we treat this is that the share option, the fair value is the value determined at the grant date. What did we say was the grant date? The date at which the option is what? Incepted, okay? Or at the inception of the option. So that is the tutorial on that. Let's just look at the question there, and we see the treatment. On May 2012, Marchant made an award of 8,000 share options to each of its 7 directors. So these are the big guys. The condition, that is the golden handcuff. The condition attached to the award is that the directors must remain employed by Marchant for 3 years. The fair value of each option at the grant date was $100, and the fair value of each option at 30th April 2014 was $110. So there are two fair values here. One was at the grant date and one was at the year ended. We are not interested in the one that is at the year ended, because when we are valuing share option, we use the fair value at what? The grant date. It's 100, no? And then I use you. That's very important. At 30th April 2013, it was estimated that 3 directors would leave before the end of the 3 years. Due to an economic downturn, the estimate of directors who were going to leave was revised to 1 director at 30th April 2014. The expense for the year as regards the share option had not been included in profit or loss for the current year, and no director had left by 30th April 2014. The question is, how do we account for this? In a simple language, right? So, stay with me closely. We're going to have year here. We're going to have the current year charge here. We're going to have the cumulative amount. Then we're going to have the calculation here. It's just our presentation. Okay? When did it start? 1st May 2012. So it started 1st May 2012. So the first year ended will be 30th April 2013. So at 30th April 2013, how many employees did we say they will leave? No. There were 7 employees that we gave the option to. But we have estimated that 3 of them will leave, isn't it? If 3 of them will leave, then how many will be left? 4. So to get the value of the share option as at the end of the year, we will only calculate for the 4 people. So 4 times Obiabeti 8,000 times the fair value of $100 times 1/3. Because that is the first day. Arithmetic, please. What do I have? So we can say 1.07. You agree with me?
Is it 4 times 8,000? 106,000. Is it 4 times 8,000 times $100 times 1/3?
Yes, that's how we are punching.
So 106,000.
106,000. Now we are working in million. So if we are working in million, if you convert that into million, you agree with me to be 1 point. Then it should be 0 point. Can you punch that again? Because that's not the answer I have in my working scheme.
So 1.06.
1.06.
1.07.
Okay. Okay.
In millions.
In millions.
0.0666.
Yes, so 1.07. Have you confirmed? Confirm it.
But my question here is that
okay,
we are estimating credit directors moving on.
Yes.
Estimates.
The rule about IFRS 2 is that when we are calculating the value of the share-based payment at every end year, we need to take into consideration the people we have estimated that they will go.
What do you know?
If they don't go, then nothing will happen.
So they don't go. We really have provision for them in the first year. We thought they will go next year.
Yes.
So this year we didn't provision for them.
We didn't make provision for them.
But they didn't go. So
yes.
How do we then account for?
Okay, how then do we account? But then you see, one of the things is that it has to be as at the end of the year. As at the end. And it is also not going to be likely that when they will all actually work by the end of the contract. And when it even gets there, it is not likely that all of them may even have the money to what? Buy the share or will be willing to buy the shares. So that is the rule we follow. But what you are saying is a typical scenario that will come in practice. Now,
the 100,000, but it's not divided by million that will give us millions.
how did you get it wrong?
Divided by 1 million.
They are in millions, so if you punch the 4 times 8,000 times 100,000, you divide it by 1 million.
Yes, you get 0.
Confirm it.
You don't get 0.
Okay, let's go. So 30th April 2014. Now, look at what happens. So this is where your issue you raise come in. Look at it. At 30th April 2013, estimated that 3 people will leave. Okay. Due to an economic downturn, the estimate of directors who were going to leave was revised to what? 1, as at 30th April 2014. So now, if we are calculating the issue about share-based payments at the end of the 2014, how many employees are we going to make provision for? 6. Because economic downturn, when they leave, they won't work anywhere, so they won't leave. So now we will provide for all of them. 8,000, still 100, but this time around to be 2/3. Okay, that's the second year. 2/3. What do we have? So the 3.2 is the new figure that will be taken to the balance sheet in respect of share-based payment options. But last year we provided 1.07 until we strike it out. The difference is what will go to the income statement. Are you following me? This figure we just had for 30th April 2014, this is how much we will carry in the balance sheet in relation to the shareholders option. But last year we had provided 1.07. So we will just look at the increment, and that is what we will charge in the income statement for the current year. What's the difference, please? 2.13. So that is what will go to the income statement in relation to the share-based payments. Simple, like that. So you see how the accounting standards are coming to play. It is when you're strong in accounting standard, let's just say a Yahweh. Last one. A loss on an effective cash flow hedge of Nathan of 3 million has been included in subsidiaries' finance cost. What does that mean? A loss on an effective cash flow hedge of Nathan of 3 million has been included in the subsidiaries' finance cost. Please note that losses on hedge are supposed to be accounted for in other comprehensive income. But in this question, It has been included in where? The finance cost of Nathan. So when we are preparing the financial statement, we will subtract that 3 million from finance cost in relation to Nathan and now bring it to other comprehensive income in Nathan. Sounds good? So we subtract it from Nathan's finance cost and now recognize it as a subtraction in other comprehensive income. That is all you gotta do. It's all you gotta do. It's all you gotta do. So these are the workings. So let's look at this. So what are the companies we have? We have Marchant here. The man doesn't have R there, or it doesn't have R. This thing I've written some. Okay, so the Marchant, who? Nathan in the middle. Option, third. Clean this up. Option, third. Then we're going to have total here. Now, so you're going to feed me up with the workings we've done and the various things that must be done. So, I think I need to put adjustments in the middle. Then I put total here. Let's go. What comes first? So go to their, just go to their income statement. We are moving at this point now, at this place now. So revenue, how much do we have? 400. 115. A liar has a tail. What did I tell you?
6 months.
6 months. So be careful here. So when it comes to option, all options results we are going to be bringing will be half. We are taking 6 months because we've disposed of our controlling interest on November 1, 2013. So we've lost control. So 6 months of that, what do we have? 35. Next, what do we bring? Cost of. But adjustments, you better revenue of what? 12 net premium. So what I say, in total, no, it will reduce. Cost of sales. How much? 312. 65. Half. 18. And then intergroup 12. We add it technically to reduce it. Can I have arithmetics for the totals, please?
for revenue.
538. Stay with me closely. Cost of sale, revenue minus cost of sales gives us what? Gross profit. So let's go. Since someone is already here, can you give me the answer there? 200 for who? Yeah?
Yes.
Okay. Individual.
Marchant.
Ah, did you say this figure was 538 or 58?
5 let me tell you. 538 115 538.
Please, when I write, kindly see it, okay? 155. Yes, who is ready? Who is ready for me here?
Okay. So 88
For who?
for the first one, Marchant.
88.
50 for later. 70. 70.
Okay. There you go. Next one. What do we bring from their pro forma?
Other income.
Other income. Let's go.
21.
Now, I want you to stay with me here. Adjustments begin here. 21 for Nathan, isn't it?
Yes.
No, sorry. 21 for Marchant.
Yeah.
How much is for Nathan?
7.
How much is for option?
1.
We take half, right? Nice. Now, when it comes to Marchant, remember the thing they did. What did they do? The issue about, so you go back to workings, where they dispose of something. Wait.
2. Disposal of 40%.
The gain on the sale now, almost they add the other income, no? You bet here free 5.3, no? Do you remember? The gain on the disposal, on the sale of the holding, 8% holding in Nathan, no? 5.3, have you seen it? We subtract it. Then the gain on the disposal in option, how much was it? 22, isn't it? We add it up. So now Marchant's account is going to be these three guys. Yes, madam.
Just to take you back.
Yes, sir.
The cost of sales.
Mm-hmm.
So this thing last week we rather add the cost of sales to it, then it reduces.
Say, wait, again. Until when we bring Paul, it will still reduce it. Anna. It's nege. So we bring Paul. This is Paul. So that's why we bring neg to reduce it. Are you getting it? So it's going to reduce it because these are negatives. So it's because when you add these three guys, aren't they more than this? They are. So when you add this, it reduces. Boucher, are you okay? Now, have you seen these figures I'm talking about?
I've seen the 5.3.
The 5.3 is about the 8% shares we sold in Nathan. The 22 is about the gain we got when we sold our 40% share in option.
And the 21.
Is it 21 or 22?
You have 21. Okay, the 21 is the figure on the face of the sheet, right? Yes. Okay. Got it.
Yes. So now let's do the arithmetic. So what do I have here? 37.7. Good. What is next that we have to bring? Administrative cost, right? Admin cost. Please stay with me and give me the figures. Admin cost, what do we have?
15 for
Marchant.
9 for Nathan.
9. And we take half.
So
6. Good. From there, where do we go?
Other expenses.
Other expenses.
35.
Now, you've stopped giving me total here for the other income. Don't worry. When we finish, we'll do it. Let's go. Other expenses. How much?
35.
35 here, 19 here, and then 4. Half, right?
Yes.
Now, there are other items that are supposed to be here as part of the other expenses of the company. Like what? Impairment. Do you remember the issue about the impairment? What did I tell you about the impairment? The impairment of goodwill. That 5 that we said we need to subtract it from
95 minus 5.
no, not the 95 minus 5. The goodwill that was taken to 17 instead of 12. Internally generated fund. The 5. That's what we have to bring here. Then The share of associate profits. How much did we get?
1.5.
Okay, that will also come as an addition to us. Then the service cost will also come. Net service cost that we said we have to take to the income statement. How much did we get from our workings?
That's 7.2.
7.2 service cost. We subtract. What else must we bring? The revaluation loss. Do you remember that? PPE. Now, please give me the workings numbers and let me put it there so that we can make reference to. In the impairment loss was workings what? 2. Share of associate loss was workings what? 4. The IS 19, the service cost.
6.
PPE expenses, the revaluation loss.
7.
How much is it? 2.36. The one we said should be taken to the income statement. Are you getting the picture? Then what else? The share option we did. The share option.
Yeah, okay.
Work is it? How much? 2.13. Good. Good. Good.
It's right, I think the first year's one has been recognized.
Yes. It has been recognized. But you know,
The expense.
yeah, the 1.07
Yes.
has been recognized in last year. So we only recognize the increment in this year's financial statement. So help me out with some.
The finance cost they've already included.
Which finance cost?
You said they've included something in finance cost. Will you please?
Which people? Nathan? No. Who?
The cash flow hedge.
Yeah, we will deal with that. Now, you see, we are following their pro forma here. So we need to get operating what? Expenses.
Okay.
So all of these things will come before we get the
okay.
operating expenses. So let's see what we get for operating expenses. How much am I punching fast the money? Which one? Second one. 47.
First one, 60.51.
60.51.
Last one,
8. Now, give me group. But look at what we are going to do here. I want you to look at what we are going to do here. The total level, the other income. Add that for me. What do I get? 45.7. We subtract. Then admin. Another one.
No, other income.
This plus this. Okay, it's added. Thank you. Then admin cost.
Admin cost, why is some added?
The 9.
Okay, it's supposed to. Then that means this answer is wrong.
Yes.
Thank you.
That's 30.
30.
No, I mean, yeah.
Yeah. 30.
No, it's 29.
29. Okay. Now, look at what we're going to do. We can soup up all of these things and bring the total here. So in souping up all of these and bring the total, it means minus, 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 plus, minus, 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 and bring the total here. I hope you are understanding what I'm saying. You could bring them separately, but you can soup it all up also and bring the total under the total. I hope no confusion.
Why not we?
Let's do it one after the other.
The share of profit. Why is it not? Why are we adding it to expenses? Shouldn't we show it separately?
Yeah, it has to be shown separately on the face of the. That is why it's shown separately.
But when we do that net thing,
When we do that net, you know, we will go to the consolidation. Then we will subtract it again and show it again. And
you do another console.
yes, we will prepare the group account, the group P&L account. The reason why we are doing this is that at the end of the day, we need to get the transfer to how do we call it? Controlling interest and non-controlling interest. That's why we are doing this.
I don't think you have to do this.
In the exam, no, you have to do this. Now, this can represent our group. Do you get it? The total represents our group.
Yes.
No problem. It stays there. I hope you are getting it. So let's stay with this. That the total represents us, the group. Now let's go. So you said we should move one, right? So let's move one. This minus this minus this. What do I have? This will be minus 5. Let's bring it there. This will be 1.5. I bring it there. This is 7.2. I bring it there. This will be 2.36. I bring it there. This will be 2.13. I bring it there. Am I right? Yeah.
That one is 58.
58. Take it out. Boom. So give me arithmetic for group. Yeah. After operating expenses, should be operating profit. After operating expenses, no. From the preamble, after operating profits, from the preamble, where do we go? Finance cost. Have you seen that, Madam?
Please.
Finance cost. How much do we have? How much do we have?
Finance cost. 5 for the Nathan.
5 for merchant.
6.
Nathan. We subtract that and then
4. 6 then 4.
Are you taking half? 2. Thank you. Now be careful here. Ahanamika Chirel said the examiner said in Nathan's book there was what? Loss on cash flow hedge. That has been included in where? Finance cost. And I said it shouldn't be there. So cash flow hedge. Cash flow hedge. To ye free hop, we are going to add. Sounds good? Okay. I'm continuing from here. So let me just rename. So we follow the order. Marchant, Nathan, option, and total. Mebacho, what is the next item? Finance income, and that's an addition. How much? 6? 5?
4.
Half.
4.
Okay. 15. Total here will be what? 13, I guess. And 3. What is next? After that, we are supposed to get what? Profit before tax. So can I have arithmetic?
Oh, 61.51.
For merchant?
Yes.
31.
10.
10. 102. What else from here?
Income tax.
Income tax expenses. How much do we have?
19.
Uh-huh.
9.
Uh-huh.
2.5.
Did you take half? From there, we come to profit for the year.
42.51. 22. 7.5.
So total. From 13.5. 13.5. 72.0. Okay. Okay. So that's our profit for the year. Then we bring the other comprehensive what? Income. What are the things we mentioned from our workings that must come in other comprehensive income?
Gain on investment.
How much?
5.
Right. Where would that be? For who? For who? Marchant, I guess.
Yes, Marchant.
Next one.
Then the hedge, cash flow hedge.
Cash flow hedge. For who?
For Nathan.
How much?
3.
It was a loss, right?
Yes.
So we deduct. What else?
That's right.
Employment benefits.
Employment benefits. Very important. The remeasurement. How much was it?
2.
2 million. Is that all that we are supposed to bring?
And then we said the PA in the debit revaluation surplus. I don't know what that
Mm-hmm.
was. It said the revaluation surplus. So
Yes, so we debit. To come under other comprehensive, the 2.2, right?
yes.
To be negative. Are these all the things we're supposed to bring here? I guess so. From our workings. Yeah.
What is the revaluation supposed
No, you see, we took the net to the
to be? Yes.
expenses, PPE expenses, but instead
The 300.
No, it was what has to be charged to the income statement that we are bringing in. But the revaluation loss that has to be charged must come into the other comprehensive income. And now,
the revaluation loss, actual revaluation loss was 4.6.
yes, and we share that between the revaluation surplus and then what? The income statement. The difference that we have to charge to the income statement is this figure, 2.36. But we said we would debit revaluation surplus with 2.2. And now,
Yes.
so that's what we are bringing here. Revaluation surplus comes under other comprehensive income. And I'm ready.
But you know, if we're doing balance sheets, the revaluation surplus in the balance sheet. So we've credited it.
But doesn't revaluation surplus or loss isn't it treated in other comprehensive income?
Yes, before it goes there, if there's balance sheet.
That's it.
And now there's no balance sheet.
But
we
we still
have
have to-
reversed it. Then ideally we should have brought it here again, the gain here.
Which
That's
gain?
what- the gain that
The
we
gain was last year. The loss is this year. It is the portion of that loss which we will write off against what was or what is in the revaluation surplus is what we bring in. If control what I said. So that's the idea about it. So that's why we are bringing it in. Okay, so let's get the totals up. 5 on this line. Right? Neg 3 here. Neg 2 here. Neg 2.2 here. So that is it for us. So let's get the other comprehensive income for the year. Option doesn't have anything. So no problem. Yeah. So other comprehensive.
Total 2.2. No, total.
Okay. 2.2. Negative or positive?
Positive.
Should be positive. No, sorry. This say we're negative.
Okay.
So this should be negative. Middle will be 3. Here. What is it? 0.8. So total comprehensive income for the year will be what? Total comprehensive income for the year will be what? This plus this. Okay? These people, they won't have anything there. So let's see what we get respectively.
43.31 first.
19. This will still be 7.5. And then the net effect. 69.81. Good. So that's it. But I can't hear about what I say. This is the total comprehensive income for the year. This is the total profit for the year. But we need to divide it between the controlling interest and what? The non-controlling interest. I hope you know that. So how do we do the division? So finish and then let's do that last working. And that's all.